What's up, Legacy Builders? I'm Rob.
I'm Reshawn, and this is Learn, Hustle, Grow.
Learn, Hustle, Grow is about creating a legacy. We're here sharing our passions for money, marriage, and travel with other legacy builders like you.
Are you maximizing your employer benefits to help build wealth?
Before we left corporate America to become entrepreneurs, we took full advantage of our employer benefits. Let's talk about how you can too.
It's that time of year. Fall is becoming a distant memory, and we are racing towards the winter months.
Throughout our careers, the October-November timeframe usually mark the time to review our benefits for the upcoming year.
If you have health insurance, and we hope you do, you are no doubt familiar with open enrollment. Open enrollment generally occurs once a year.
As insureds, we have anywhere from a few weeks to a few months to make changes to our benefit plans.
In addition to health insurance, your benefits may include vision, dental, life insurance, and other perks.
We engaged in this process every year for the last 20 plus years.
This year, we are going through the process via healthcare.gov. Yep, we have Obamacare. Before we go any further, make sure you like, subscribe, and share this video.
Want to stay informed of our future videos? Hit that notification bell.
While it is tempting to just leave things as they are, we advise you to always review your options. You never know how a small change could help or hurt you and your family. Companies change plans and premiums often.
This is why you have to look at both your plans and the options provided by your spouse's employer.
You might consider using both insurance plans. One of my former employers served as backup insurance for Rob at a reduced rate.
I chose the least expensive option through my employer.
The least expensive option at his employer and my company as a backup was less expensive than his choosing a better plan at work.
I presented 2 insurance cards when it was time to pay. We never came out of pocket for any of my medical expenses.
Remember, once open enrollment ends, you are locked in. These are your benefits for the next year unless you have a qualifying event.
Qualifying events are defined by the IRS. This means they are the same regardless of who provides your insurance.
The IRS defines the following as qualified events: marriage, divorce, adoption, birth, or death. Rob and I personally experienced a qualifying event when we were married in 2009. This presented an opportunity to add our youngest son to my insurance plan.
Be aware that some companies require that all changes be completed within 30 days of the event. Don't miss that window.
Employer health insurance is one of those benefits we tend to minimize. We take it for granted because it has been part of our employment package for most of our lives.
Many people decide not to follow their entrepreneurial passions after researching the cost of health insurance. It was definitely something we had to evaluate.
Under Obamacare or the Affordable Care Act, monthly premiums are subsidized based on your anticipated annual income.
The lower your income, the higher your insurance discount. These plans vary state to state.
Unlike a plan provided by your employer, you are not allowed to cover children who reside in another state.
We are a blended family. When we move to an ACA plan, we cannot cover our youngest son who resides in California.
When we compare Texas ACA plans to our corporate health care, there is a noticeable difference. We pay higher monthly premiums and higher deductibles.
None of this was news to us. We understood that healthcare will be one of our largest expenses when we decided to leave our jobs.
There were expat options we could have chosen for 2019 based upon the fact that we were out of the country for 6 months.
Those options wouldn't have worked for our oldest son, whose hiring date was delayed until August of this year.
Our 2020 plan will cover just the 2 of us until Rob receives VA benefits.
We take the following into consideration when choosing our plan.
Doctors as in-network providers. This matters because we have established relationships with our physicians.
If you have recently relocated, this may not be as important to you.
If you do not require a specialist, this may be less of a concern. If you are flexible regarding who provides your annual physical, this may not matter to you at all.
Next, does the plan cover ongoing prescriptions?
If you suffer from a chronic illness like high blood pressure, diabetes, or Crohn's disease, you want to confirm coverage.
Drug coverage is one of those areas that we can mistakenly believe that insurance is going to take care of.
We also look at copays and out-of-pocket maximums. We've narrowed down our choices for 2020.
Within our options, the out-of-pocket maximums are almost the same across the board.
Take note as to whether the copays are a flat rate or a percentage model. If you see a specialist often, a percentage-based model can really add up.
Let's address the question of deductible versus monthly premium. If you're young and healthy, there's an assumption that you won't use insurance much.
As we have children and get older, we start to feel a little less invincible. The deductible becomes less of an abstract and more of a real thing.
Your first thought might be to get the least expensive health plan option.
Choosing a health plan based solely on your current wellness will not contribute to your opportunity to build wealth. How can a health insurance plan impact your ability to build wealth, you ask? Keep watching.
The HSA is the primary reason we favor a high deductible insurance plan.
A health savings account, or HSA, can be a good way to offset some of the higher costs of healthcare.
With an HSA, you're allowed to put pre-tax money into a separate account that can be used to pay medical expenses.
To qualify for an HSA, you must be enrolled in a high deductible health plan. The 2020 contribution limits for an individual are $3,550 and $7,100 for a family.
Married couples, your employer sends all annual contributions to the IRS. When you file your tax returns either jointly or separate, your shared HSA contributions cannot go beyond IRS limits.
I was fortunate to work for an employer who contributed to employee HSA accounts. Find out if your employer does the same.
The one thing that we all have in common is that we are aging. Now is the time to plan for your future. An HSA account can help you do that.
Unlike an FSA, flexible spending account, the funds are not use it or lose it. Contributions to an HSA follow you wherever you go.
When you leave the company, you take the money with you. If you have no health concerns, the cash in the account continues to grow.
HSAs offer triple tax benefits. Contributions are tax deductible. Contributions grow tax-free. Withdrawals are tax-free as long as they are used for eligible medical expenses.
Some benefit plans offer you the opportunity to invest the money in your HSA. That's right, you can put that money to work.
As the beneficiaries of a Cadillac healthcare plan, we deferred the high deductible plan for as long as we could. Eventually, we took advantage of the tax benefits of an HSA, but we did not invest the money.
You can be better. Do you see how the right insurance plan can help you build wealth?
Speaking of putting your money to work, this is a great time to look at your 401k contributions.
The maximum IRA contributions for 2020 is $19,500. This does not include your employer match.
The combined employer and employee contribution limit for 2020 is $57,000.
For participants ages 50 and over, the additional catch-up is $6,500.
If you skipped a few years in your youth, this 401k catch-up contribution might be a reason to work beyond the age of 50.
Are you maxing out your 401k? If not, will 2020 be the year that you change that?
If you cannot max it out, can you increase your contribution by 1%?
Review your benefits in their entirety. After we file our taxes, we take a closer look at our W-4 exemptions for tax withholdings.
You can change your exemptions at any time. We review after filing our tax return in preparation for the following year.
As a high-income married couple filing jointly, we never received a refund. Investing in real estate reduced the amount that we owed.
At a certain point, you begin to accept the fact that there will not be a refund. We were happy when we did not owe.
This changed when I became a licensed realtor. That's another conversation.
There are some who prefer to owe rather than receive a refund. They consider it a loan to the government. Make sure your exemptions match your strategy.
In addition to dental and vision benefits, consider participating in an employer-sponsored legal plan.
Does your employer offer a legal plan? Is it worth it? The answer is, it depends. These plans are geared towards handling matters of a personal nature.
The plan provides you with a list of qualified attorneys. There is also a negotiated discount.
Here's how we took advantage of the corporate legal plan. We used the plan to cover the cost of wills and a living trust. Is your house in order? Do you have a will?
We also used the plan to find attorneys out of state. Yes, you could Google.
We appreciated the fact that the company sponsoring the plan was responsible for due diligence. They had to know that these attorneys were legit. It was like getting a referral.
Moving on to life insurance. Should you get life insurance? If so, how much?
Employer-sponsored life insurance is generally the least expensive life insurance available. In addition to the price, there is also the fact that no physical exam is required.
Life insurance is the opportunity to pass down tax-free wealth. That's right, in the event of your death, your life insurance beneficiaries will not be taxed on your life insurance proceeds.
When considering how much life insurance you will need, it depends on what you want for your beneficiary. Take a look at the following. Do you want your beneficiary to be debt-free? What are your total debts? Homes, cars, credit cards, etc.
Do you want to fund a private school or college education? Do you want to help your beneficiary take some time away from work?
The older we get, the more expensive life insurance becomes. A will and life insurance are the foundations of estate planning.
Is your foundation solid? Our legacy is how we will be remembered. What will you leave behind?
Are you maximizing your employer benefits to build wealth? What's the most difficult part about open enrollment? We want to hear from you. Comment below.
See you in the next video.